Hello, this is Eric Carbonell from Skeptics.com, and today I'm going to talk about the balance sheet of the Federal Reserve. This balance sheet lately has started to look like a horror story, and I'm not going to go into all these programs in this particular video. I am just going to explain what the Fed's balance sheet looked like in December 2005, before the whole financial crisis started. The reason I chose December 2005 is because I'm going to link a great PDF I found that explains the Federal Reserve's balance sheet at December 2005, explains what all the different entries are, which it explains what all these entries here are, which I'm going to do too quickly. Now, for all this to be easier to understand, I put it into Excel. This is all the data taken directly from the Federal Reserve's website. So that's right there's the liabilities. Up here is the assets. Now, quickly before I start review of balance sheet. On one side of the balance sheet you have assets, things of value, physical property, or amounts owed to, in this case, the central bank. And so you'd have assets here. The other side, liabilities, it's IOUs. So it's who, in this case, the central bank owes money to. Now let's take a look at the assets. Now, the way financial statements work is whenever you see something indented, it's a subcategory of the entry above. And so right here, securities held outright, subcategory of total reserve credit. And what total reserve bank credit means is these are IOUs to the Federal Reserve. That means in the Treasury, for example, owes money to the Fed, and banks owe money to the Fed. And on that note, Treasuries right here are the biggest asset class of the Federal Reserve in December 2005. It's $744 billion. And okay, moving down the balance sheet, you have repurchase agreements. Those, in this case here, most likely treasuries, have been purchased from the market at, this is the market value, $28 billion. Fed printed $28 billion, paid it out, sent that out into the money supply. Then it booked those treasuries at par value on its balance sheet. And repurchase agreements reverse themselves. So whoever the Fed bought these treasuries from, it's going to sell them back to in the future. Okay, here loans to depository institutions. Those are banks that are in trouble and have gone to the Fed for money at the discount window and its other lending facilities. It's not that much back in December 2005. These other float and other reserve assets, the foreign reserve of the Fed is in this right here. They're small balances, and you can have a look at the PDF if you want more specific details. Next important thing to note is the gold stock, which we have doubts if it's actually there, but that's the gold the Federal Reserve claims it has. These, again, go ahead and have a look at the PDF. It's complicated to explain. It has to do with the IMF, and it's a right to currencies of other nations. Complicated. And so let's just quickly move on and see that of the Fed's assets, 90% of them are treasuries in December 2005. Okay, now let's have a look at the liability side, which is in some ways very interesting because this is where the money supply, the base money supply, which is the dollars in your wallet can be seen. These turquoise entries are the amounts that make up the base money supply. Here you have currency in circulation. Currency in circulation, Federal Reserve notes, IOUs from the Fed. And that's what you see on the liability side here of the Fed's balance sheet. This, as we saw, is the Fed's repurchase agreement with Treasuries, the amount it paid out. Okay, these are amounts the Treasury has deposited at the Federal Reserve. It's not part of the money supply. This right here, it's a technical balance needed for clearing amount checks and balance transfers, wires, whatnot. It's how amounts needed for the financial system to work. Other, I don't know what that is, but the amount's insignificant. Down here, this is reserve balances held at Federal Reserve banks. We'll get to that in a second, but banks need to hold a certain amount as reserve against deposits. So in the United States, it's 10%. So for every $10 in bank deposits in banks around the United States, they're holding $1 in reserve. So adding all these amounts together, we get the monetary base. And also, just so you see that it balances, these are total assets, and these are total liabilities of the Fed, and so it balances. And as you can see, this 90% or 95% of the Fed's liabilities make up the monetary base. Now, how does all this relate to the money supply? Well, that's very easy. Right here you have a chart of the U.S. money supply, and right here is that monetary base we saw on the Fed's balance sheet. And if you remember the reserve requirements, 9 out of every $10 needs to be saved at Federal Reserve. Well, M1 right here, part of the U.S. money supply, that's checking accounts, and that was created by loans from banks, and the 10% reserve requirements in the currency portion of the U.S. money supply. Next, here, this is all saving accounts, money market accounts, retail money market mutual funds, small time deposits, certificates of deposits under 100,000. M3 up here, the broadest definition of the U.S. money supply, includes all time deposits, CDs, no matter which size. It also comprises deposits of Eurodollars. Now, Eurodollars, if a European bank has a checking account in dollars, that isn't insured by the FDIC. And as we found out, banks don't keep physical cash to back up all deposits. So unbacked US dollar deposits in foreign countries make up euro dollars. They aren't insured, and they're part of this M3. Finally, there's the repurchase agreements, which we saw, which would be a small part of this. The Fed buys treasuries, increases M3, and then that reverses eventually.